Moat is quite an interesting term, right? They use.
Yeah, that's what Warren Buffett used. I mean, he got a good sense of humor. So, moat is he used the term moat is referring to certain kind of franchise or kind of ability for a company to protect their business from outside competition.
Hi, welcome back to our Curious Investor series, where we break down complex financial topics and help you make informed investment decisions. I'm here with Redmond and I'm Lana. Hi, Redmond.
Hi, Lana. Thanks for having me again.
So today our topic would be value investing. So let's reflect on the recent passing of the giant Charlie Munger. So he is very famous for his value investing. And I think he changed a lot in the values of or the investment approach of Warren Buffett and also the Hathaway, right? So yeah, and I think from before that, actually Warren Buffett was just investing on cigar butts. That's what he called it. And after that, actually after his suggestion, he actually started investing in See's Candy's shop, and it turned out quite well. See, it's so it earned significantly 2 billion accumulative earnings, and so what's your view on that?
Yeah, I mean, certainly, Charlie Munger is a very great investor, and his approach is a little bit different from Warren Buffett's initial approach. And so, as you said, he has made a big influence on Warren Buffett's approach and also how Berkshire Hathaway, the company, make the investment. And yes, See's Candy is a kind of watershed because it's before that, as you said, Buffett liked to invest because he learned from Benjamin Graham, and he invested in those stocks is deeply discounted to the assets. So that's what he calls a cigar butt. There's something is a throw on the street and that but still have some value. So because of the See's Candies and Charlie Munger actually make a good case for that, and they try that and then to make good profit. I think that changed a lot on Warren Buffett's approach. The key thing is the important thing is Charlie Munger is really emphasizing that it's convince Buffett to say to invest in good company,
Quality.
Yeah, good quality company at acceptable prices, and rather than to just insist on very cheap price, but it's a more and they end up with more mediocre company. So that is a big shift on the approach, and it worked very well between two of them. But it doesn't. This is not the only approach in value investing, but there's something they implement very well.
So speaking of value investing, could you help us to revisit its essence?
Yeah, I mean, it's value investing. So we know it's. I think we can say it pretty much started with Benjamin Graham and David Dodd, and in their book, very famous book, and I think the number one thesis of it is the market is sort of fluctuating up and down, and asset prices also fluctuating up and down, and so sometimes deviating from the intrinsic value of those assets or those companies. And the number two, I mentioned intrinsic value because it's for value investors. They believe that is for all those assets, there's an intrinsic value. There's some value that is more stable. It's not going to change, fluctuate so much. So then the third one is so if you have the market fluctuating or the asset prices fluctuating all the time, and then you have a rather stable, more longer term value in that particular asset, then that follow the third thesis on value investing is you buy when the assets trade at the price of the asset trading much below the intrinsic value, and then you want to sell it when it's much above the intrinsic value. And what Benjamin Graham called is the difference between the intrinsic value and the price, prevailing price trading is what he calls the margin of safety. So you want more margin of safety when you buy a stock.
But that seems to contradict to the strategies of chasing the price momentum. So a lot of people do that.
Yeah, there's a lot of people do that. I mean, there's many people make it very successfully, sort of trading according to price momentum. Yeah, but you're right. I mean, for value investing, for those people, adopt a value investing approach, and I mean, that is not the price momentum that's important. Actually, a lot of time is for value investors, they tend to have some kind of a contrarian thinking or contrary thinking. So what it means, it does not mean that they always want to go against the crowd, because the crowd sometimes is right. And for a lot of time, actually, value investors would like to ride the market trend as well, and the trend of the asset as well. But I think that the key thing, what they call contrary thinking or contrarian thinking, I think it's really is that to willing to look at some of the directions, based on the information available, look at some of those directions is different or even opposite to the prevailing market belief, and to feel comfortable to challenge and to your questions what you are told. And I think this is the mentality for value investors, because sometimes you have to really to do things different from what the market pricing in. So I think that is one of the very important mentality for value investors, to be able to be a contrarian. Yeah, but not all the time. But it's a thinking. It doesn't mean that you have to do things opposite. But it's just saying that you have to be willing to be different, and you will. You also. And also one thing is that you don't fear to be missing out. I mean, you accept that sometimes you are not participating.
So just like John Templeton used to say, who's also a very famous value investor, he said it's impossible to produce superior performance unless you do something different from the majority, right?
Yeah, correct. Yeah, he would say that, and that's very true. And value investors usually believe that, because they are willing to buy things undervalued by the market. So by definition, that's a little bit different from most people are doing. Otherwise, it will not be undervalued. And but also we have to remember, and as the famous British economist John Maynard Keynes once said, the market can stay irrational longer than you can stay softened. So have to be humble, and we don't go against the market all the time, and we need the margin of safety to protect us. But we think that we believe that things will be moving in cycle. Like another very well known and successful investor said, Howard Marks. He's the founder of Oaktree Capital, and he said is that we can't really predict, but we can get ourselves prepared, get ready for the economic cycle, the credit cycle, the market sentiment cycle. And so when the asset prices move in cycle, and then we get ourselves ready and we can pick up good stock at very good value when the times come at a very inexpensive price. And so that is exactly why value investors usually emphasize the importance of have quite a bit of margin of safety.
So about margin of safety, can you elaborate on that?
The margin of safety is actually a protection, and it's the difference between the price you pay for asset and the intrinsic value of the asset. So the larger the difference, that is the larger of the margin of safety, that gives you more protection. That's why so when we talk about because we cannot predict, right, as we just talked about it, and then there's also cycle and the economy, or also your market sentiment and so on. So when it's in downturn, and that the margin of safety can protect you. You can hold on the position and then can stick to the good business, and then that can give you time to when things better, then you can get back to a profitable position. Yeah.
So can you tell us some of the most frequently used metrics to determine a company's intrinsic value?
Yeah, for in value investing, there are three usually primary sources of intrinsic value. And number one is the value of the asset. So I mean, just one thing I need to emphasize is not just the book value, because it's book value is an accounting concept, but there's many adjustments you need to make. And so, but we don't have time to go into the detail. But look at, of course, one of the rule of thumb, and I think some investors, value investors, like to use is like look at the liquidation value, or look at maybe the replacement cost of or the whole all the assets of that particular business, especially some of the competitors, so they need to, if they need to rebuild the business, how much they actually need to spend to build that plant and things like that. So that is better than the book value you look at just from the balance sheet. So, and there's some of those consideration. Of course, you need to look at a lot of those contingent liabilities and things like that as well. And then the second one is is the earning power, the value of the earning power. That is talking about the more the current and earning power. So that require less forecasting, and that basically is a look at the business as to what they are at the moment, and then based on the margin, if the margin can actually stable, and then you look at how much they're earning, then you can discount all those cash flow based on that earning. But of course, once again, accounting adjustment is important. You look at the receivables, payable, all the accrual, and all those things you need to at the cash flow that you need to make some adjustment to that. So that's one of the, and the second, and the third is the value of growth. Why do I separate the earning and the growth? Because it's if the current earnings is really easier to more stable, but the growth is more uncertain and difficult to assess. So for value investors, they only give value to growth that to companies or in business that they can maintain their competitive market position. So those growth can actually be sustained, and rather than to just relying on the management's promises, or just you definitely you cannot draw a straight line to assume the growth to continue. And so it's so they're really focusing on the business, the competitive market ability to stay competitive, to protect the market share, and also very important, and to be able to maintain the margin when they are growing. So I think that is like what usually Warren Buffett say is he like the business with a moat. Yeah.
Moat is quite an interesting term, right? They use.
Yeah, that's what Warren Buffett used. I mean, he got a good sense of humor. So a moat is he used the term moat is referring to certain kind of franchise or kind of ability for a company to protect their business from outside competition. So a moat, is the surrounding to protect the castle, right? The medieval castle from the enemy for attacking the castle. So that he used that as an analogy to mean that actually there's a certain thing that help the company, either the ability of the management or the product or the brand name or many things, and that help the company can maintain the market share, maintain their margin, maintain their growth in the industry. So actually, because of this emphasis of moat, instead of just buying things very undervalued versus the asset, that's why make Warren Buffett and Charlie Munger investing in great company like Apple, Coca-Cola, and Moody's.
Does value investing include estimations of intrinsic value?
I think it's when investors do try to estimate the intrinsic value, but they will not be too dogmatic or stick to it by the word, because it's they understand that it's the key thing is the intrinsic value is kind of thought process to anchor the thinking that so for any asset there should be a value rather stable. So you don't want to overpay much above that value. You want to buy it cheaper than that those intrinsic value. I think that is the important thinking process for value investors. But because of it's very difficult to predict the exact number or even range for intrinsic value. Just like Warren Buffett himself say, it's intrinsic value is an estimate, and then he said it's even himself and Charlie Munger and look at the same facts, and they will come up with two at least slightly different kind of estimation for the intrinsic value. So he said, okay, we never told you what intrinsic value we come up with, but we have that intrinsic value in our mind when we make the investment. So i.e. that whether investors do not just follow the momentum and be very careful about not overpaying for what the long-term value of the company or asset. But I mean but they also accept the fact that they have to be humble, and this valuation is only an estimate, and it's only a guide, some kind of reference. Yeah.
So what's your view on value investing? Do you think it's the best strategy?
I mean, I quite like value investing strategy, but I would not say there's anything is the best strategies. It depends on the what kind of market cycle, and also depends also on the investor's objective, and also the investor's own preference. Because it's I mean, many different investors can use different strategies. Actually, sometimes can be very successful. For example, I know some very good investors. They do very, very well using the price earning momentum, for example. And earning momentum basically is track the analyst upward and downward revisions of the earnings for a company. So you buy those companies being consistently having upward revision and in earnings, and you get out for those companies actually more acceleration in the downward revision. So some investors do very well. I mean, it's using that, and some are using quantitative strategies. So writing code and so on, and doing back testings. Some using just technical analysis. Some will also use. I like even some will use the old Peter Lynch way. You only invest in something you look at invest in company that make products that services you go to the shopping mall to check. And so I mean, different investors can have their different kind of strategies. I think one of the good things I like about value investing strategies is really that give you a reality check. There's certain kind of intrinsic value. Bear in mind that, so they help you to stay firm, to say not being drawn into sometimes was the market getting too exuberant or a little bit too optimistic and deviate from the reality. Then you have something to a reference point to help you to say, okay, maybe I need to be more careful. I don't want to overpay. And also, when everybody making money, that on certain asset that you think they're actually deviating from the value, then you have something to hang on to say, okay, and also give you some confidence to not to get being dragged into that, and because of the fear of missing out and so on. I think that's the important thing for good thing about value investing. But it is not the only approach. But there are many approaches, as I said, work very well for many investors.
Of course. Thank you, Redmond. Thank you for watching today. Stay tuned for more videos. And if you like this, please like, subscribe, and also leave a comment. Thank you.